Okay, so here goes. So as we said, based
Excuse
on
me a
this,
bit, sir.
yes?
I know what you wrote on the board. I know one is the password to the.
No, man,
for
none of those. You are already on Zoom, so don't worry about it. That's just a
Okay.
password for those who are in the room and those who were not on Zoom. From you're in the class, you're good to go, man. Don't worry
All
about that.
right then.
All right. So what I'm sharing, everybody see my screen, correct?
Yes.
All right. So the revenue, there were two sales line. Everybody agree?
Yes.
Everybody pick that up, right? We're going
Right.
to, so please say no if you didn't see it so we can go on the TV again, Okay. Now, the cost of sales. The cost of sales, really and truly, they were basically two sales items. As we said, we didn't see any closing stock or anything like that. So we just pick up the cost of sales that they had and the purchases that they had in the expenses.
Okay,
Right?
I do not have the return.
Right. So, okay, no problem. So you're out by the 470. So so the cost of sales pretty much will just be the cost of sales in the TB. So generally we know opening stock at purchase less closing stock, but we didn't have that information, so we just pick up from the income statement. Cool? All right. Now there were other income though that we need to add. For example, so when they put it at the bottom or at the top is fine. Okay. So the other income was other income, interest income, other miscellaneous income. These were all monies coming in. That would increase your profit, right? So that would add to your basically your profit. That would increase your profit. And then going down now, you had all the expenses. You had the farm account. Now, if you assume the farm account was a cost of sales, it's okay. It's okay. So that's what I'm saying. I'm not worried about the categorization real, to be honest. So if you believe, because you can, that's reasonable to believe that the farm account is a cost of sales because a manufacturing company. So that's fine. Okay. Freight and shipping costs, if you believe, yeah, that has to do with carrying the raw materials. If you want to include it in cost of sales, that's also fine. Okay. It's still an expense. That would have been fine. As I said, we're not going for an IFRS format, We're just trying to tell a man whether they make a profit or a loss. That's what we want to. We are only interested in filing them on taxes, one with the right profit or the right loss. Which line it in is not really, as long as it's a balance sheet, a stay in the balance sheet, and an income statement, stay in the income statement, right? That's what's most important to us. And this is why I'm saying I'm using exactly what the student did. So yeah, I would probably would have put some things in different category, but no matter, the same profit or loss I would get as well. Okay. Now, wages, again, if it's manufacturing wages, you might say a part of cost of sales. Not really matter. Cool. So the wages now, however, the wages, if you look what the student did, I want you to see if you're looking up in the top of the formula column, you see equal sum, trial balance 2021 B 97 to 102. What the person did was realize that a couple of the accounts were salary account from line 97 to 102. Let me go on it and let's look. See if that makes sense. See there, 97 was wages expense, 98 was wage expense, NIS, NHT, ed tax, hard, casual labor. So that's what the individual did. Them just sum all of them and say, all right, that is the wages line. Cool. So all right. So we have the wages, good to go. So now let's see now. So we have the wages in, we have the other expenses. I want to see if I have all of these other irrecoverable GCT have to be expense. The restaurant expense, accounting fees, casual labor. I want to see if we have all of these lines, So all of these lines coming up. The electricity. Why the electricity? Electricity was more than one line. Electricity was in from 112 to 117. Right? Now, what this student did, I can say, the student listed them based on how the accounts were and then mapped them so as not to miss one of the expense items. Right? So that's pretty much what the student did. And then grouped what was grouped because I realized, wait, it's more than one line, this one expense is in. I don't need to list it several times. So again, all the expenses going right down, all of them going right down, all of them salary and wages, staff welfare, for water, reconciliation, discrepancies, even discount allowed, all of those lovely stuff. And then at the end of the day now, end up with a net loss of $13.8 million. I don't know if anybody got that, right? But if you didn't, then what we need to do is to see if we had picked up all of the expense line. First class? First class?
No.
Last time you on a line. Okay. So well, so the internet is the APT student, that one. And the password is 2000 _ books. Right. of course, it's Zoom ID, it's Zoom ID. Yes. Yeah, so anybody got that number?
Not me.
Anybody got close to that number?
No, sir.
I get all profit.
Ah, that means we probably left out some of the lines. So let me show you something. One of the things I did
Yeah, I
with this
didn't
trial
pick up.
balance,
I
right?
didn't finish you.
Okay, no problem. One other thing I believe I did with this trial balance, no, this is not the original one, but I think with the original one, I drawn a line under where you had valuation surplus. Did
Yes.
anybody have the TB in Excel open?
Yeah,
I
there's a
believe
line there.
there's a line there. The line there was to indicate to you that all the accounts below are the profit and loss accounts. So what was important is to ensure that you accounted for all of those accounts.
Okay.
And remember, in your profit and loss, what we say, so in your profit and loss, everybody remember dealer? Let me see, remember dealer? I did debits and credits in a minute, right? Hopefully y'all got it, right? So dealer, the R represent what again?
Revenue.
Revenue. And the R is on which side of the account?
Will be on the
Credit side.
credit side.
So in your income statement, everything on the credit side is income, right? I'm going to say very basic. I'll say revenue since using R, but it's not, them don't use the word revenue exactly, but they might say revenue or other income. Cool. But just for simplification, again, for tax purposes, want it on the credit side for the income statement, it's revenue, right? It will increase your profit. And then all the debits are expenses, because the expenses on the DE, that one, right? All right. So if you account for all of these, meaning if you just do a sum from the foreign gain and loss, all of those, and then a sum for everything that's going on and subtract it, what do you get? Right? That's your quick check and balance, your profit and loss. So when somebody wants to know whether or not they made a profit and loss and they have a TB, what they do, they pick up from all the income statement accounts, they add up all the credits, add up all the debits, just the income statement line too, right? So just make sure that no balance sheet line is in it. Add up all the credits, add up all the debits, subtract the debit from the credit and see, right? So if the credits exceed, then it's a profit, right? But if the credits is less, it's a loss. In this case, that's what was the case. It was a loss, right? So I don't know if everybody, and if, as I said, they may not have gotten that close, but don't worry, we have a case that we are going to do today. It says the loss is because of the farm account added as an expense. So did you have the farm account?
Sir, sorry.
Yes.
So the EPL recoverable, doesn't that go on the balance sheet?
No, recoverable. Where is that? Where is the EPL? Where is it?
164, line 164. It's almost at the bottom, the second to last one.
EP levy recoverable. Okay.
I know EPL goes on the expense and the income statement,
So
but this is a recoverable.
If you notice, I have this in blue, meaning it's debatable, meaning only expenses should be below, right? But somehow this TB was, because this is an actual company TB, by the way. Somehow the TB, it ended up with this balance sheet that come down there. So that's in blue, meaning if you put it as a balance sheet item, you would get the marks. If you treat it as expense, because all the expense should be there, you get the marks.
Okay.
Yeah.
Irrecoverable, remember, irrecoverable is expense there.
And sir, the coding in the TB is kind of misleading.
Does that go for the farm account also? Line 90.
Line, which line? Line what?
90.
90.
Yeah, right there.
Because
that can look like a balance sheet.
Yes, because yeah, the farm accounts, I put it on the balance sheet as well.
Yeah, move it and you put it down here.
You see that one? No, I can't remember who this client, what this was for this client, if it was an inventory account or was actually an expense account. But again, I can see I think y'all are too brilliant.
There's another farm account on the top.
Because I told you that, just assume that everything on there. So you see, I believe I was clear when I said y'all should assume that was our income statement account.
It's look at the account number. Look at the account number 13.
Yes, hear them all account number. Oh my lord. I realized the account number does appear like it should have been a balance sheet account.
Yeah.
Yes, Rahim, maybe you have a question?
I was wondering why the cash is on the credit side if it was.
No, man, that's a reality though. They're not supposed to have a cash account. That's a reality. That was, yeah, that's.
Repeat that, please.
That needed a lot of clearing. That had a lot of control account and stuff. So, but don't worry about it being there. Just
I was
everything as
that was
bank,
what
the
was
cash
messing
and
me up,
bank,
and for
put it all as
the
bank.
NCB current account, because it was
But
on
hold
the
on, we don't
credit
reach balance
side.
sheet
I
yet. We
thought
don't reach balance sheet
I'm
yet.
saying it's
So
an
I know we are
overdraft, so I
pushing
put it
it.
as
So I think Rahim had
liability.
a question. We don't reach the balance sheet yet. So we sort
Right.
about the cash. Yes.
A question on the
Hold on,
income
one second.
statement,
Go
sir.
again. Go again.
Question on, can I go back to the income statement, the shipping
Yeah.
and
Hold
freight?
on. Rahim, you had a question? Are you good?
Yes, sir, but they kind of covered it. It's on the point of the account numbers. So
Okay.
because it's what I see daily, like listing items or categorizing them by numbers like that. So even though you said different, I did what I'm used to, I guess.
Understood.
All
No
right,
problem.
it's okay.
Okay. All right. So assuming that all the accounts below the equity accounts were P&L accounts, this would have been the loss. However, you all have eligible increment points based on the account number. One, it should have been balance sheet. Based on the name, possibly should have been a balance sheet account. So there's nothing wrong with that. That's the reason why, as I said, we're going through to discuss it. So for the balance sheet, we may end up similarly having a similar issue. But again, for the balance sheet, how this was done. You're on the Zoom? You're on the Zoom?
Process we tend to carry over. So you did not process the pain that you went through last year, but you still bring over that pain, that hurt, that disappointment. Things didn't go as planned for that year. Leave it in 2025. Let's go into 2026. When my sister had died, my emotional energy was shattered. I had to seek help, yes. And there's nothing wrong in seeking professional help. I did.
Going back, just look on the screen, right? You look at the screen?
Healing did not.
Karen, your mic is on mute.
All right, yes, so there are some mics unmuted. So I'm going to mute all until and then I just each person unmute when you have a question, and then mute yourself again after. All right. So going to the balance sheet, you have your non-current assets. Again, if you had something somewhere else, I'm gonna kill you. But assuming everything up at the top are balance sheet items, you had your non-current assets. Now again, how this was listed, one of the reasons I am, don't worry about the year being up, the year showing like that, but it's the same trial balance, by the way. So what was happening, each of these columns, you had the cost, you had the accumulated depreciation and then the net values, and then the total going down, 240 being the 260 being the non-current assets, the current assets being 90 million, all of those, current liability being 230, having your net current asset being a negative, then you have your non-current liability 1, and then you had your equity accounts, and that's where it balanced. Now, how did it balance? Because you had your retained earnings statement, so you know the profit you made for the year. So this was the loss for the year. You had your valuation surplus, and then you had a retained earnings account on the TB of 32, bringing your amount to the 26.4 million. So I
Could
will
you share this file with us so we could go over it? Could you share this file with us?
Yes, I'm going to share the file. Yes.
Okay.
Yes, because I don't want to spend too much time on it. Yes, I will share the file. But again, so at least it's just to give us a little idea of putting the things together. So in most cases, the accounts, the TB accounts may not be all over the place, but if 1 or 2 is over the place, you can fix it. But generally, yes, down at the bottom, you have the income statement accounts, and up at the top you have the balance sheet accounts. All right, so yes, so I will share this. As I said, this was a student's attempt, but I like how the attempt was done because each account was listed to be mapped. Now, generally, as I said, if you're doing a balance sheet, you're going to be grouping them and they're going to look much more lovely, but we're not worried about IFRS at this moment. So that's it for that. We are going to come off the assignment now. What we're going to discuss a bit now is the allowable and the disallowable. So I mail you a lot of stuff. A lot of the GCT documents I did is for your reference. We're only going to be looking at a few of the documents today. So it's good everybody is seeing my screen, but I'm going to just select which ones, the documents. Just going to share my screen again, just to select the documents that we are going to be using today. The first one I want to go through. So all of these you all have. So I will just select particular pages to discuss. You can go through the details because you all have this. It's good resource material. All right, so you all can go through the details. So don't worry about it. If you notice that, okay, hold on, I didn't see that part, I didn't touch that part. Don't worry about it. Don't worry about it. You have all that information. One of the first things I want to look at now. So we did our income statement, right? What we have to now look, because a lot of the times you are filing taxes, you may not start out filing taxes for a group of companies. You may start out for individuals, partnerships, small businesses, okay? So generally now, you really want to know what type of expenses are allowable and what type are not allowable. And this is what we want to look at now, firstly, before we get into our GCT aspect. So again, allowable versus disallowable expenses. Now, we're looking at basically our tax system. And what are allowable expenses? Allowable expenses are expenses that are incurred wholly and exclusively for business purposes and are deductible from your taxable income. So that definition is important, that it is incurred wholly and exclusively for business purposes and are deductible from taxable income. The purpose, they reduce your tax liability under the tax law. That's the purpose. It reduces your tax liability under the tax law. So what are some categories of allowable expenses? So generally, your operating expenses, your day-to-day business costs are allowable. Admin expenses, right? So that office and operational support costs generally allowable. Repairs and maintenance, upkeeping the business property, upkeeping the equipment for the business, allowable. Employee expenses, so their salaries, their wages, and their benefits, allowable. Interest on the business loan, not personal loan, but interest paid on the loan used for business operations. So if you have a personal loan where you bought a car, or you have a personal credit card, these are not allowable expenses, right? Because you're buying your grocery with that. That's not allowable. What's allowable is everything that relates to the business, all right? So some examples. Rent for business premises only. So not the rent for the house, not for the rent for the apartment where you have uptown, right? Utilities, electricity, water, and internet use for the business. Again, so not what you are spending current at home. Travel expenses, only for business related travel. So not because you go on a vacation, you want to expense it. Hold on, now, even if we don't want to get into the work from home. So I really, let's do the general stuff first, please. I know we're going to have these questions, but let's go general first, and then we can deal with the exceptions. All right, so just give me a second. Let me just go through this, and then we'll deal with the exceptions. Travel, advertising and promotion, costs related to marketing and promotion, again, for the business. All right, professional fees, fees paid to legal, accounting, and consulting firms for business advice. So not because you want to purchase a home, you go to the lawyer, pay some consultancy, and you're trying to pass it through the business. No, that's a personal thing. It's not a professional fee that should be included. What are the things that are now not allowable? What's the definition? These are expenses that are not deductible from taxable income, often personal or not directly related to the business operation. So they're often for personal reasons. The purpose, though, is to prevent deduction of personal or non-business related expenses. What are some common expenses that people like to pass through, but they are not expenses that should pass through for tax purposes? personal expenses, like the personal travel, the vacation, capital expenditure, things that they purchase for themselves, their own land, their own machine, their own vehicle, and it's not for the business, not in the name of the business, not used by the business whatsoever. Entertainment expenses. So they went to a big dinner and they want to pass it as meetings, right? Even though it has nothing to do, they didn't gain any client, there was nothing about any, they just went to want people to see like them make money and boy, you know, them spend some money. Cool. Penalties and fines is another common thing. Now, when people late with their taxes and they incur all these massive penalties, or they have a court case and they have to pay these fines, they want to pass it through so that they don't pay taxes, but it is again not allowed, right? Another thing I've seen commonly that clients do is that for argument's sake, remember, so 2023, 2024, so 2024 basically, they made $2 million in 2024. $2 million is what they made. The income tax they were assessed for was, let's say, $400,000. Cool? That was the income tax they were assessed for. Now, but this payment is done in March 2025. So when they made the payment, cool? Now in their 2025 income statement, you see they have income tax 400,000. That has to come out because that is placed there so that they reduce their profit, right? But the reality is your income tax is not an expense, right? Yes, it's not. So you have to pay that income tax, but you cannot pass it through your income statement. It was a liability. You pay the liability and it's gone, right? So that's a common thing that many people do. When they pay certain taxes, they expense those taxes. But on a certain work, you can't expense the income tax. The income tax is a liability, is a tax liability. When you pay, the liability is no longer outstanding, but it's not a legitimate expense. Other things, for example, that are noted and that are highlighted here: luxury or personal travel costs, gifts and donations, unless it's specifically to approved tax authorities as charitable contribution. So yes, you know, you give somebody a money, okay, you give a friend a money, your friend have a hard time get the money, you put it as donation, but it's not going to be considered donation. Or you give a friend the money that are really out of your profit that come out of, because that's not going to be considered. So yes, your friend broke, let's say, all right, let's say for argument's sake, the roof blow off, right? And you feel some way, and you help the friend, you pay for the roof, cool, but guess what? That is not a legitimate expense that's coming out of your profit. So unless your friend has a registered charity, right? Unless, for example, the government give exemptions for Melissa relief, which they have done, right? So yes, so yeah, unless you can prove that this was related to the roof of somebody when that's blown off, not me who decide to upgrade my house and change my roof when nothing affect my house and then put it as an expenditure. Yes. Yes, but there's a I just use the extra, but what has happened is that the government is giving a lot of leeway for Melissa relief because it was so devastating. But generally, if you're helping out a friend in crisis, they don't care. But generally, if you're helping out a friend in crisis, doesn't matter, right? But yes, for the Melissa relief, there is a lot of leeway given because it's so devastating and there was so much damage. Okay, so that's, Melissa is not the right example, but I'm just using an example, right? Right, okay. So, and other things, a private use of business resource, non-business related repairs, it have nothing to do with the business, penalty for late filing. Again, so you see what it said? Even if you file late. So let's say argument sake, the PAYE you're supposed to pay was 200,000, right? You never accountant, never file it. All of that gone up and take on 400,000. You know what you have to do? 200,000 of the PAYE, you know, at that of the PAYE, you know. You see that 200,000 that can't expense, right? I mean, you can put it through this was doing money, but when you're doing the tax calculation, you have to back that out, right? You have to back that, add that back to your profit, right? So, what are the key points then? So, with all of that being said, what are some of the key points that are necessary? So, is you have to ensure that you keep your records properly. So, practical tips: keep your detailed records, separate your business and your personal expense, and consult with a tax professional. If you don't understand or if you have been doing your tax training, then have an idea what's deductible, what's not, what's allowable, what's not. So, all right, so we had some questions. We're not going to move off this. What are the other questions and clarification we have now regarding the allowable and what's not allowed? So I can try to address one. One of them, for argument's sake, is if you're working from home. There is a particular amount that the government allows that will say that if you can prove that you have a designated office space at home, then they will approve a certain proportion. To some extent, they may approve about 20% of whatever that cost is. So if you have a designated space, and let's say you have a 3-bedroom house, and 1 bedroom, it's clear that if they come and they look, that bedroom is not a bedroom, it's an office, right? So they will say, okay, you're utilizing this space. So it's 3-bedroom, all of those, let me say that's 20% of the house. So, okay, we'll allocate 20% of the rent. The utilities, whatever, since this is where you're spending majority of the time, 9 to 5, okay, 25% of the bill or whatever. So that allocation can be discussed. You can't expense everything because you have an office table in your living room, right? So that's not the office space they're referring to. So yes, if you have a desk in your living room, which is fine, but then the whole rent for the entire house, you want to put as office rent, right? The entire house is not the office, right? So that's one of the things you have to be mindful for. So they do allow you prorating if there's a designated space, but not like us where we work from a lot of the time. If there's not a clearly designated space, then there's no proportion that's going to be happening. You're not going to have a proportion. You're going to have to prove to them that that's where you're always working from. So I don't know if you're going to do that. If you're going to have you serve your camera inside your house and recording yourself every day to show that that's where you're working from, I'm not sure. But unless there's a designated space within the home, it's very difficult for you to apportion any of your house rent and utilities as business expenses. Okay, so any other thing we want to consider in terms of what's allowed and what's not before we move to GCT?
Before you go on, and you
Yes.
just said the rent thing, but
Yes.
let's say not paying rent, they're paying mortgage. How you allocate that?
No, similarly, as I said, if you have a designated space,
Yes,
you'd have to be a discussion in terms of how much you prorate. So a benchmark that
Okay.
normally is used, it wouldn't exceed 20% of whatever you are paying, right? That's
paying,
a typical
okay.
benchmark that is used. Some people may do less. When you use more than that, it kind of raises alarm.
No,
Right, but
20 is
again-
fine enough.
Yeah.
Sir,
again? Yes,
so you have a residential property
yes.
and that's your way of income. Whatever expenses incurred on that, can you not use that residential property in the as being, say, for example, you live in a housing scheme area and you rent out that specific house. So you're not living there, but you rent it out because it's your form of income. Isn't that allowed?
Yeah, but the income is allowed to, So you're gonna remember that this is no rental income. There's like whether you're doing rental or Airbnb, this is no income. So the rent that you collect is income. The expenses you incur on maintaining that rented house is an expense. So that so and I'm sure so you would be making money, but yeah, it's allowed, but not just the expense, not just the expense,
But the
income
income as well.
for. That is correct.
Okay.
That is correct. So just like an Airbnb. So for Airbnb, all the monies you make it from the Airbnb, yes, but all you're spending on the Airbnb, filling up the fridge, whatever, the cleaner, whatever it is, everything else that you're the mortgage or whatever it is, then that expense would be going against
So
it.
one other question, sir. In regards to like the allowance, say for the property, that would be, we can use that and use it as a markup based on, say the property is not mortgage, because I know if it is mortgage, then that's a different case. So say the property is owned, it was fully paid off for. On the say you're filing taxes, you can actually use the entire property.
Property tax.
No, not property tax. I'm trying to find it's capital allowance.
All right, I'm trying to understand now. So this, when you say capital allowance is only on business assets. So
Yes,
are you
but the
doing
fact
business
that
with
the
this?
property is the fact that the property is rented, so it is your income. You're not
Okay.
living there.
Yes, man. So everything is accountable if you are treating it as your source of income. So
Income.
this is what you're earning, right? So the capital allowance on that asset, yes. But as I said, as long as you are treating it, as long as you're accounting for both the income and the expenditure and the relevant allowances, then that's fine. The only challenge is
Okay.
if all you're looking at is on the expense side. So as long as you are recording all income generated, then the expenses and the relevant allowances would still go in place. So it would be, for example, just as how you have your building, right? So everything would be allowed. Everything would be allowed as long as you make sure you account for the income. Okay. Yes. Which one? It's scrambled. For which one? The tax course? You have Microsoft Office on your machine? Is it Word it opening in? Probably that's why. You have Office on the machine or no?
No.
All right. So probably what you can probably try to do is convert it to PDF. And it actually is the only one I didn't convert, you know. Can convert to PDF and then you'll be able to open it easier without those. I think that's what's happening. Yes. Yeah, man. No problem. All right. So we are outside of that. So moving on. Yes.
In Prime, I wasn't sure, right? So
Yes.
when I take my staff out of the lots. What is that?
No, man. So that's staff benefit. That's staff welfare. That's fine. That's fine. You did that with your staff. This is not when you go out with your husband for dinner. That's different, right? So yeah. So as long as yes, man. That's business expense. You carry them, you treating them. That's fine. That's legitimate. Yeah, and even your customers. Yeah, man. To clear. Yes, man. Very clear. Very clear. Hmm? Again, yes. The staff, customers. Yes, staff, clients, yes. Generally, it's within our, yes, I was just about to say. Once they are modest, right? So for example, a plane ticket for a client would not be considered modest, right? So once it's a modest, unless you're an airline and it's really costly, I'm assuming. Yeah. And that's probably something that's not costly, it's just a free seat they give them on a plane that's traveling, that's not always full. Then that might be a little bit different. But generally, gifts are allowed once they are modest. Right? Yeah. The nature of the business. Right? Nature of the business. Something that you realize that this amount is not going to affect your tax liability. Let's just put that. It won't actually impact your tax liability. That's what is money. Right? So if you see that this gift is going to wipe out your profit, then you're not going to consider that money. Yeah. And this is why I say depend on nature. It's a multi-billion-dollar business. Even if they give out $100,000 gift, it doesn't seem like no, because they still have a whole heap of taxes to pay, right? But you making $1 million and give a $800,000 gift, then clearly you never want to pay the tax, right? So that's a little thing to use. Yes. Mm-hmm. Mm-hmm. No, man, yes, company vehicles. Yeah, man, yeah, that's fine. Yeah, man, capital allowance. Yes, so if you're in the company name, so the company purchases for the staff, so the company owns it, the staff utilizing it for the day-to-day business. All fine, yes, and capital allowances are on it. Eh? No, the staff will end up using the personal use, but for them to commute to work, right? So even though they, yes, so that's still fine. Yes, so it's not like them have to park it at the office and one and take a bus to the office. No.
This was all one staff exclusively. You have to apply tax that for already for that staff. It has to be for
Yeah, man, the line.
It has to be general.
General, line staff. Yeah, for like management.
Aside one specific staff, you have to apply for tax.
Yeah. All right. So let's get the lovely stuff. All of this we're going to discuss. Don't worry about it. GCT is what we say we're looking at because I have a case I want us to do in class. So let me just bring up some of the documents that I sent to you. One of the
I have
let's
a
do one of the
question,
big things.
sir,
So
before you move on.
yes, go ahead. Go ahead, go
So
ahead.
with regards to expenses,
Yes.
how would you treat, would expenses incurred for like a staff party?
Go again for
Um,
staff party. Again, that is considered staff. That's considered benefit. That's reasonable. Unless again,
So
unless this party is cost so much money where the business gone into deficit, then yes. But generally, these things are allowed. They are allowed expense as staff benefit. Hmm? Yeah, so the one I'm going to open now is the one that says GCT 0 rated and exempt items. That's the one I'm going to share on my screen now. That one, GCT 0 rated and exempt items. Yeah, and as I said, we're going to go quickly through. This is a comprehensive list of, so we know, so GCT, we know here that GCT is pretty much 15%, okay, generally. Yes, 20% and 25 and all of those lovely stuff, depending on the telecommunication, tourism. Yes. No, somebody asked a question online? With a director's retreat, again, yes, generally, management retreat, they're expected to go have strategic meeting. As I said to you, as long as it's not something that wipe out the profit, as long as something that put them in a deficit, it generally will be allowed, right? So generally, it is allowed. As long as them not go over the top with it, but generally, it is allowed. So we're going to look at the general rules, right? Sometimes there are exception and it might be disallowed because it's too much, but generally it is. Okay, so let's now look at some list of 0 rated and exempt items because as I was saying earlier, we know our standard GCT being 15. Okay, we know we have the tourists, we know we have telecommunications, we have 12 and a half, we have 20, we have 25, but all right, just whatever the rate is. However, there are items that do not attract GCT, right? So whatever business we're doing and whatever person we're filing taxes for, it is good to know the nature of their business, right? When you know the nature of their business, you may realize, oh, you don't need to file GCT because everything you're doing here is exempt or it is 0 rated, okay? So even when you're doing your filing, you're going to file, okay, 1 million, since I don't need to file because once it exceeds the $10 million, you have to file. But it's just whether or not we're going to say the sales is $2 million, 0 rated is $2 million. So, okay, you're good to go. So even if your item, and this is a very important point, even if the item, so for example, one of the things they said is 0 rated is what? Animal feed, right? If you are selling animal feed, so you decide that you know what you tell Hyper, look here, you know, so nobody not sell feed down at Portland, more have a little outlet out there. Cool, so all right. And besides that, they went with you are the sole provider. Now you realize that one good down there, 3 million a month is what your income coming in. So you're gone past $30 million. So but you have to file GCT. So yes, it's 0 rated. But what you're going to be filing is 3 million as your sales and 0 rated 3 million. Right? Yes. So that's what you're going to be. So you're not going to be end up paying any GCT. But your income exceeds, so they want to know as long as, because how it works, whenever you file your, whether SO4 for an individual or partner, or your ITO2 for a company, whenever they see that the sales, because the system, remember, you know, how the system works, you know, that's how computer works. So it's as long as a company put in 10 million, once that digit is there, it come up to say, hey, do they file GCT? Voila, then have the GCT account open and let account based on our assessment. Well, there was no assessment. It's based on what you define, right? Based on, so you want to bid. How do you know? That's not good, no assessment. And the revenue when you file an ITO or SO4, but a fantastic letter come in that you should not apply for GCT account, opening an account, right? So we know as long as your revenue passes 10, you have to file. Doesn't mean you're going to end up paying GCT because you might be doing business with items that are exempt or zero rated, but you still have to file. Okay. So what are some of the items? Again, I'm not doing the whole list. Animal feed, fishing apparatus, fertilizers under the tariff, certain agricultural produce, certain vehicles, you know, and it's specific, right? So goods excluding motor vehicles other than ambulances, which are acquired on behalf of, right? And even specific company, whether St. John's Ambulance, UA Hospital. So these things are quite specific as to what is zero rated, right? And then the list is exhaustive. I just really want to glimpse on it and show us that we have a list here that we can use to see. So for example, even certain books, printing services for the production of printed matter, types of books, types of vehicles, persons recruited overseas by UA for employment at the Bona campus, you know, specific things. So it's very, very detailed, right? So it's 16 pages. So those were the items that we had, that we said were zero rated. We have other goods, for example, it says that was taken out, goods and services that are exempt. So the top part was dealing with zero rated. This is exempt. Similar effects they will have when you end up not paying, right? Travel tickets for international travel. Again, this is specific to certain, we have to look under the act with that specific too. So not just anybody want to travel, right? But this is specific to particular industries. Raw food stuff that is locally produced and raw food stuff that is imported, that you're importing it in order to give further production. And it gives, and it specifies ground provision, etc. Lots of stuff on the list. I just opened this list just to show you what some of the things that I shared with you. Another thing here is just looking at that. Let me just share this here. Just for us to know, okay, what's the difference? What's the whole difference? Is zero rated exempt? The difference between zero rated and exempt supplies under the GCT Act is very important, very important. Why? Zero rated, these are taxable supplies, but the GCT rate applied is 0%. Cool? What that means? You understand what that means? Because it's important to again know the difference. Sometimes when we file a GCT, we just put it anywhere, right? We put any one of the box. But I think it's zero rated or the exempt, just put it on one of the box, right? That's normally, I'm telling you from personal experience, right? Yes, put it on one of the box. You don't know, zero rated exempt, what's the difference, right? But there is a difference. And that's why you have that, we have that list now. Because look at it. The supplier charges 0% GCT to customers. However, the supplier is allowed to claim input tax credits. That's the thing with the zero rated. So you can't charge the customer any, but whatever you paid, you can claim it. So you can get refund or offset for the GCT paid on the inputs related to making the supplies. So you see why that's important, because the zero rated. Can't charge the customer, you can claim the GCT you pay on it. Right? So you can claim it, meaning so I get a refund. Yeah. Correct. Yes. So you can claim that. Example, basic food items. So to get flour into bean flour and manufactured rice and whatever vegetable you have, any GCT you pay to bring it to that state, you can claim that GCT. You just can't charge a customer GCT on those items. Okay? Exported items, same thing. Some medicine and healthcare items. So what's the implication of this zero rated? Supplier get back GCT paid on purchases and expenses used to make the zero rated item. So for zero rated item, you can claim the GCT you pay and you get it back. So any expense to make that item, you can claim the GCT that was incurred in making the item. Exempt, however, no, exempt. These are non-taxable supplies and no GCT is charged to customers. What is the effect? You cannot charge GCT to customers. You cannot claim input tax credits on things you paid to produce it, right? That's the big difference. For example, educational services, medical services, residential rent, certain financial services, example, loan interest. So the implication, GCT paid on the related input becomes irrecoverable GCT, right? So that GCT, you cannot recover it, you have to expense it, right? So that's the main difference between zero rated and exempt supplies. That's the main difference between zero rated and exempt supplies. Now, there's a lot more there to do, but one of the main thing, as I said, when we get the zero rated and the exempt, is excluding those, because we can't charge on it. But as we said, for one of them, which one of them would say that we can claim the input? Which one? We'll see if we put it already. Ah, lovely. Ah, because the rate is 0%, yes. So zero rated, you can input GCT, you can claim it. But for the exempt, can't claim it, that expense it, right? That have to go through your income statement. So we are going to do a case. Now, there is a case, everybody's a case study. Case study that was in the email. What I sent today. So I also, yeah, case study, Blue Wave Electronics. Sorry. Okay. So there is a case study, Blue Wave Electronics. So before we do that case study, I'm going to give a few steps in prepare, because I want to prepare these financials right here, right now. So we're gonna give you all about, I don't know, maybe 20 minutes maximum. Yes. So you don't need 20 minutes, but we're gonna do it right now. No worry, just say still all of them kind of shaky. All of them kind of very shaky. All right. So let me see. I realize there's a comment here. Let me just make sure. Yeah, man, the example as they pretty much gave us example, you know. So rice, vegetable, flour. So remember, flour is a process, you know. So flour is a process. So you might be spending in order to get the flour to the process. You're gonna be spending items and ingredients that you pay GCT for in order to make that flour, right? So that is a flour is one example. So even though you can charge it to the customer, in making it, any GCT you pay to carry the cost of sales, or so your purchase cost, your manufacturing cost, everything to get it to the state of where it's not edible flour, any GCT you pay, you can claim that. Right? So it's the example is going to be dependent on whatever the business does. Everything they spend in order for it to get into the state where it is usable, where it is transferred to the customer. If there's any GCT paid in that process, then they can claim it. They just can't charge it. All right. So as I said, there are a few pointers I wanted to do before we get into that case. Like, let me just use this case as our case to continue doing a quick financial statements, and not only that, working on some GCT. In doing our financial statements, generally there are a few adjustments that are necessary. Some of the quick adjustments are what we call accruals, prepayment, depreciation. I mean, you have one provision, but when we depreciate one set of provision, right? So there are three key things we need to know. That even if we don't do accounting and we want to file taxes, as I said, we just want to work out the profit or loss. This is important. Accrual simply means what is owed, right? Prepayment means what you overpaid, right? So accruals mean what is owed. So for accruals, what is the treatment? And I'm doing a very basic treatment. For accruals, the treatment is if it is what you're going to have to add it to your expense that you incurred, right? So accruals, if they tell you that, you know what, I paid my light for 11 months, but December light didn't come in, right? I pay $1,000 a month for light, so I paid 11,000, but I don't pay December yet. What I know is 1,000 a month. So in the trial balance, you're going to see 11,000. But I am going to make a note and tell you, I did not receive December's bill as at that date. but the bill is $1,000. So I'm giving you a note. What you are going to have to do to accrue it, meaning you're going to have to say, even though it's 11,000 was paid, and that's what I see in the expense, I'm going to have to put 12,000 as the expense. And to balance it off, that 1,000 I'm going to put it as owing, as a liability in my balance sheet, right? So I'm going to put it in my, so I'm going to add it to my expense, and then I'm going to add it to my liability in my balance sheet, right? So that's pretty much what I'm going to do, what is owed. Prepayment is the opposite, meaning that we can't bother. Them always, you know, I want to cut off the internet because they always do this thing. So what I did is that I paid in advance because they give you the bill of 1 month before it due when it can tell you that this is their amount, right? So the bill that is due in January, then do from early December and send it to you, right? And say, no, I don't want to forget this bill, but then we'll cut it off. So you pay it. So you end up prepaying. So similarly, you end up paying 13,000, right? The other 1,000 when you pay wasn't for this year, really. The extra 1,000 was for January the following year, right? For prepayment, what you're going to have to do with the prepayment is that you're going to have to subtract it from the expense, and then you're going to have to add it to your asset. Because pretty much it's like them owe you. It's extra money. It's like your money just out there waiting, right? So that's pretty much what's going to happen for the prepayment. And third and finally, depreciation is basically the way how you can expense the life of your asset. So they may tell you use a percent rate, so they tell you 20% of the value, then you just use 20% and you're going to expense that 20%, right? So this 20, whatever it is, you're going to end up now for the depreciation, you're going to expense a certain amount, but you're going to realize that it's going to reduce the value of the asset itself. So you have accumulated a separate account, but in essence, it's going to reduce the value of the asset, right? Now, for tax purpose, we're going to do capital allowance next. So we're going to see how we deal with that depreciation, but we're just doing this first, right? So step by step. So these entries might be needed when we're doing our case. That's the reason why I'm giving a quick synopsis on this. So I want us to do this case, and actually I'm gonna take 15 minutes and do as much as we can, and that is the income statement. And then ask for the income statement, the balance sheet, and then the GCT filing. In doing the income statement, just treat everything as what you see on the trial balance, right? So after the note, so I'm going to be very clear with this one, because I know we are very brilliant individuals. So we see the little faults in the cases, but I want to make it easy. So let me just open the question itself. So you see where we have our notes, additional information. So this case where we say Blue Wave Electronics Limited, note 1, note 2, note 3. All right, you see where you have the other notes. You see where you have note 5, 6, 7, and 8. Don't consider those notes in doing part A, right? Don't consider them. So in doing part A, notes 5 to 8 is not relevant. When we're doing our income statement, notes 5 to 8 is not relevant. That's why I put in red. I put it in red in bold underline. Ignore GCT considerations, mean ignore notes 5 to 8. Ignore those for part A. So I'm 15 minutes, please. I'm going to give you all 15 minutes. Try and do this income statement. Pick up so try and let's see if we can try our best and do this income statement for Blue Wave Electronics. After that, we're going to now work out the GCT. That's what we're going to focus on. We will get the solutions for the case at the end, or want to work through it. This is a practical session. We want to ensure that we have an idea, good grasp.